A great little business is where you're paying, may even be slightly profitable. You're not really growing. You're making a little bit of money, enough to pay founders' salaries, but it's never going to return the type of returns that any investor expects. What are you going to do, Mr. or Mrs. Founder, in order for you to not become a great little business?
Hello and welcome to the Rule of 40 podcast, a new show about tech scale-ups and everything involved with investors and founders in the Australian tech ecosystem. I'm Josh Ayscough. With me is Jason Serda.
Hello, hello.
Today we're kicking things off with why this podcast exists and what we're going to be talking about in the conversations ahead. I'm very excited to get started, so let's dive in.
Let's go.
Jay, this podcast has been a long time coming for you and I. We spend a lot of our time speaking with founders and investors looking to grow amazing Australian technology companies and then debating out how and why they would be successful. So to kick us off, why do we need a show focused on Australian scale-ups?
I think part of it is Australian punches way above its weight. And I think on a global basis, the incredibly smart people coming out of Australia, I think that we see some amazing critical tech or tech-related startups. And I think that at the end of the day, I think what you and I do every day is we're kids in toy stores, right? Kids in toy stores are about surrounding yourself with good people. It's not work for us. We have the passion to work with these clever people to help them win. And I think that I will do this until I die, so to speak. So I think part of the passion is all about getting out there and connecting with the right type of people that have the same vision, willing to have some fun with it, but work with some amazing companies that are really going to scale internationally and go hard, right? And so good, right?
So good. And look, there's no doubt we produce some amazing technology and technology companies. So, you hear a lot about the success stories, Canva, Atlassian, Afterpay, Immutable, Fivecast, and then, we have a really growing startup ecosystem here in Australia. So your Heidi Health, WinDC, NeuRoad, Everlab. It's a really, really big ecosystem. There's lots of people involved in it trying to do various things based on, a model that's been around for a very, very long time. But as we go through that, what do you think the conversations that aren't happening in the ecosystem at the moment?
I think it's a really challenging environment. I think in 2020, we launched our first fund. Money kind of rained from the sky. It was there was definitely an abundance of people wanting to invest in this category. And I think as years have progressed, these funds have taken longer to provide liquidity and sell through. Obviously, COVID and other things have impacted us along the way. But I do think that, the days of raising money to wipe away your sins is no longer valid anymore. You can't get away with that. And I can tell you, because I've experienced it with so many portfolio companies, is, the sins go away when you raise some more money. But I think the truth of the matter is the luxury there is not there anymore. You can't raise to wipe away your sins. So I think now you've got to be on top of things. You got to manage and make sure you get the most out of your funding. You don't get a second go. And so as a result, you really do need to do it well. Surround yourself with the right type of people and essentially build what I would refer to as high growth. And I don't have a problem in not being profitable, but profitable is to a point. At the end of the day, you need to build real businesses now. These are not fluffy businesses that are dependent on the next raises. These are real businesses with real business principles. And at the end of the day, you need to get back to profits. Yeah, I've been saying now, which is quite a contradiction to 2020 days, which is profit in months, not years.
Yeah.
Yeah.
And I think, that kind of change is definitely one that I've seen as well. So I've had the benefit of working in early stage businesses at a time when, pre 2020 when raising was back in that cycle of being very difficult, and doing the 100 meetings with investors to go through the processes and getting a lot of no's, and then being part of a team that was raising capital in a peak time where it came very quickly and very easily, with 10 meetings instead of 100, and those experiences are vastly different. And we're definitely coming back into that environment now where it's much harder. And I think probably brings us back to a step back, which is a little bit of an introduction on, who is Jason and Josh. So Jay, why don't you kick us off with a quick overview of your background?
Yeah, so I like to define myself as a tech guy, an operator. I came out of school pretty quickly. My father was very entrepreneurial, and so I immediately didn't, it was always about, do uni, but I was already working. The thought process there was I had a strong interest in technology, and I think between those next 3 or 4 years, we had a tech hardware business which we ended up selling 7 years later. We had a internet service provider that we also sold 10 years later. But we had a number of these businesses that were all deeply seated in technology and what I've been referring to as this critical tech, and then. After that, we knew that the hardware business was getting harder. We wanted to move into services, and we built a tech services business called Bluefire, which we ended up exiting in 2008 to Dimension Data, or NTT. And then I spent the next 12 years as a global CTO for their services stack in that business, responsible for building all their services, and the amazing thing about that experience was that I got exposure to working as a startup, and I got experience working in a very large corporate with 18,000 people. A lot of reflections. I still think, though, that even working inside NTT, I kind of operated like a small business where we had, instead of having founders and business units, I had VPs that reported on individual services that we built. But it was a hell of an experience, and lots of learning and lots of mistakes. And I'll talk about later the arrogance that came from some of that. But it was like some really interesting thoughts about that. But then from 2008 onwards, NTT gave us the permission to invest in businesses that we liked, and we ended up building a syndicate of 20 plus executives that invested in some of the businesses and some of the technologies that we were using. And so we essentially learnt to become investors inside this big multinational. And I was also involved in all investments that NTT was doing as part of that investment committee. And being the CTO there, I got exposure to some amazing companies all over the world. So we learnt what good is, and we learnt how we can influence those. And we picked amazing winners. During that period, we had 6 or 7 both Australian and US startups that exited. We were making more money as investors than in the day job. And so, in 2019, it seemed very natural to step out of NTT, start our first fund, and I guess apply both the operate experience with the investor lens. I still work in a very similar way to how I worked back then, and I think the thought process there is, we like to get involved, we like to roll up our sleeves, we're operators first. We don't just want to place capital, right? And I think that's kind of been the journey. And so, so far up until now, we've done about 52 investments. We've done 13 exits, about to go to 14. And it's been a really good journey. I always refer to it as, Marissa, my wife, allows me to do it now, right? But I remember when I stepped out of NTT, I could see the blood drain. Like, she went pale when I talked to her about that, right? You could see there was definitely a response that I got. But I think this world has been very kind to me. Some of it is luck. But you can't beat the hard work and dedication in working with these businesses to really succeed. And I think that's the key thing is work your butt off and you can do great things. And I like to think that I never look back on leaving the big corporate. That was just the best thing that I could ever have done. Sometimes it takes time to work out, how do you become the kid in the toy store? But I really do see myself as the kid in the toy store. So,
Jay, you and I have been working together now for nearly 10 years, and I've not once learnt the lesson that I should always introduce myself first, because your background and experience
you may
is
run out of time, right?
remarkably impressive, and fortunately my intro's a little bit shorter, but so my background's in psychology. I love solving problems, so the startup and scale-up ecosystem was always really exciting for me. It's something that I was drawn to. And now sitting on the investment side it's a whole new and really exciting dynamic. The psychology background in me always drew me to health and med tech. So that's an area that I love and I think is super exciting, because the health and med tech area is just going to boom over the years ahead. And it has all the elements of technology that you love, Jay. And it's a really nice kind of coming together of the work that we do. Within utility, I'm a partner of the utility group business. I've been lucky enough to become a general partner in a number of our funds. So, I joined Jason as an entrepreneur in residence and then stepped into a partner role and now involved in managing and raising a fund, supporting our advisory businesses and supporting growth and scale. I get really excited about all things growth. So, I'll focus a lot on, go to market and the operations that are required to support go to market. And then equally the people and supporting them through the process of going through the scale up journey and building a great business.
Psych degree comes in handy, right?
Yeah, well, I think, people want to make the joke that psychologists are all a little bit nuts themselves in the background. And at least for me, that's probably true. And certainly working with a lot of founders and businesses that are going through high scale, there's a big toll on someone's mental health.
I love a bit of crazy anyway, quite frankly.
Oh, we talk all the time about kind of crazy on the theme.
Yeah.
So
right.
the environment suits me really well. So the kind of startup and scale up ecosystem was just one that always looked very exciting to me and something that I was naturally drawn to. And equally now sitting on the investment and advisory side within Utility Group, it's seeing that en masse. It's a one thing to be in a project or a business and solving problems, but, to be solving problems, 10, 20, 52 companies at a time is something that's pretty special and important. I think, it's really heartening for me because, I'm on that process of, going from an operator and learning to become an investor, and one that you've been really successful at. And I think, that's a unique part about, what we do at Utility. It's operators first that, became investors afterwards and bring that operator lens to the businesses that we get to work with every day and the founders that we get to meet. And that's always kind of really exciting. So I think, Jay, what do you think about in terms of scaling companies? How do you imagine, and what shaped how you think about companies scaling in your own experience?
I think there's no avoiding hard work, whatever you do, right? I think one of the benefits of you and I working together is I like to think that I work at a certain speed, and I think there's very few people. You Josh, match my velocity, which is quite hard. But the thought process there is, it's the hustle, right? It's understanding the hustle. It's the actual success. The success comes from resilience and getting up after you get knocked down, because you get knocked down a dozen times, right? Like you really do, and then you got to get back up again and get back on the horse. I say it in so many ways. I say we never let go of the pipeline, right? That's one of the takeaways, and the reason we know that is because you're not going to get every deal. You need to be resilient. You need to not give up. So I don't know. I mean, I reflect on all of this, that all the portfolio companies, and many of the portfolio companies we see, not all of them have all the answers, and not all of them have all the skills to do all the things they want to do.
Yeah.
So I think you got to find the right people that can surround you to help you get to those goals.
And so then what do you think people typically misunderstand about the growth journey?
Yeah, it's look, some people won't step up to the velocity, but that is required. I think there's no avoiding the hard work. Like I said, I think it's really hard. You got to sign up to that. You got to put yourself out there. But I think that you got to build real businesses now. the market is not doesn't tolerate continual raises, and like, you've got to be on top of your game. And in many cases, you have one chance to go to investors. I think investors now are kind of shifting to the right. I think they expect more for the same. And if you don't address that, there is competing dollars, competing other startups that are going to get those dollars, right? So if you're not on top of your game, I think that's a real thing.
Yeah. I think for me, there's this idea in the growth journey that it's this kind of linear process and it's a big ball of momentum. It's really hard at the start, and then you get the momentum, you get product market fit, and then this, hockey stick starts in terms of your growth. And I think my experience in a scale up and then watching them from the sidelines is it's actually really bumpy. You've got these times where you're working really hard and everything feels like it's going really well, but the numbers don't back you up, or vice versa. And then the other misconception, which you mentioned earlier, is that everyone wants to be on a growth journey. Growth isn't for everyone. That growth stage in a business it's quite unique in terms of the requirements, the thinking, the outcomes, the expectations. And, I know myself, like I'm not a 0 to 1 guy. I'm probably not 100 million to a billion guy either. Like, there are people that I've met, particularly recently, that just love those stages. Like, I'm a $1 to $100 million guy, have something and be scaling it.
And I love that, right? Because I refer to that as builders. I think both of you and I are builders. We're people that will roll up their sleeves to help these businesses scale. Maybe it's got to do with we liked Lego when we were kids.
I had a lot of Lego as a kid.
A lot of Lego, yeah. and we liked the idea of building stuff. And but I think there's something to say to that, right? Because I do think that in that $0 to $100 million journey, you are still building foundations of a business, and you need to have the right elements in order to achieve that scale. And I think you and I have got a lot of experience around that bridge, right? And I think that after 100 million, there's probably other people that are better suited, take a business public, do other things that maybe is not necessarily in our builder's skill set, And I think that we don't want to be everything to everyone. Like I want to be a specialist in that critical technology space, in this middle, right? And we keep talking about this middle $0 to $100 million journey.
So let's talk about that, because that's really why this podcast exists, is this idea of misunderstood middle. And so we talk about that a lot internally.
Love that.
It's a growth phase for technology companies. Your real business, something's working, it hasn't quite all been worked out yet. Colloquially, I talk about it as kind of the teenager phase. Like, there's a lot that's still emerging. There's a lot still that can be done. So, when we talk about the middle from an investment lens, Jay, what do you see?
Yeah, I have struggled identifying as a VC, and I have struggled identifying as a private equity guy. And I've played both sides of that. But I do feel like venture is somewhat broken in Australia. And I know that may be a controversial comment, because we've done many venture deals. But I do think that the model of writing checks without, and doing an occasional coffee is just not going to buy it anymore. I don't believe in that. I almost think like you can go to a blackjack table and go and bet on black. You can sometimes, hit better performance. So for me, I believe that there's a better way of applying that dollars. And I think that playing a more active approach to that and getting involved and be willing to rolling up the sleeves to try and help certain businesses scale and hit those goals, I think is important. And the private equity is, again, very rigid, must be profitable. They're looking for 3 to 5 times exit. That applies different pressures, and that's, doesn't support a lot of the early ecosystem that's out there,
And so why is this stage overlooked so much, or why is it not being talked about in the market right now?
I think, somewhat, PE only want to do later stage, profitable, and in many cases, not so high growth style businesses, the non-sexy, where venture is trying to swing for the bleachers, where, they want to get, 10 times, 100 times return for the one, assuming that some others will fail. I believe there's this middle where you've got up and coming, high growth businesses that need the support that kind of sit in this new category. We're calling it the understood middle, or
Misunderstood middle, yeah.
But I think the thought process here is that there's an amazing opportunity in that space. And I think if we can focus on being experts and specialists around this middle sector, we can really make a material difference, right?
It's probably the biggest thing that I noticed in transitioning out of businesses into this investment lens is, investment and financial services, it is structured stages. There are rules and things that sit around that. But the reality is the world isn't black and white. The world of startups and growth and scale ups is a very colorful world. And so, there is a big gap that's kind of emerging in this current market. And, when I think about the misunderstood middle, why is it that we care so much about the misunderstood middle, and why should other people care that this stage exists?
I don't know. The way that I look at it is, I think when we look at some of these businesses, there needs to be relationships. There needs to be people or partners or customers or some kind of experience or knowledge that we can bring to bear to help these businesses be material. Otherwise, why invest?
Yeah,
right?
It's a good point.
I don't want to be just a money investor, and I think part of that is how can we materially make a difference?
Yeah. And I think for me, it's a very unique time in a business. You're dealing a lot with execution risk. It's not so much idea risk at this stage. Businesses are evolving, they're growing their team, they're needing lots of processes. They might have customer concentration, churn. It's all happening in this one stage at the point that is, the highest likelihood or highest risk of, letting something go, or your highest opportunity to create something of real value. So, it's a really exciting phase, even if it's one that's kind of not being talked about as often. I think stepping across then, we call this podcast Rule of 40. Within utility, we have this one kind of metric that we're looking at in businesses to assess their path towards creating something of really great value. And so, it's a favorite metric for boards and investors, globally. Simple calculations, it's relatively simple. It's growth rate as a percentage, EBITDA profit as a percentage, equals hopefully greater than 40. So, for argument's sake, 20% growth rate, 20% EBITDA, 40, rule of 40.
You got it.
And the bigger, the better. Jace, as an experienced investor, what does this number show you as on the business?
I think that you can't get to rule of 40 unless you have a well-performing business, right? It's kind of a bar that many investors refer to. You need, you can be losing money and be high growth, or you can be, as long as you maintain that 40, it's a bar that I think you're investment worthy. Yeah. And I think we work very hard to get our portfolios businesses to rule of 40 that qualifies them for our funds. Yeah. And if you can't get there, that's the hurdle. And it is a very high bar. But I do think that if we look at our family offices and investors that back a lot of our projects, they're looking for rule of 40 style businesses to back.
Yeah, I mean, it is a high bar. In prep for today, I was looking at some research from McKinsey that said only 1/3 of SaaS companies hit rule of 40, and they sustain it only 16% of the time. But, in terms of it being a high bar, it is the bar I think to aim for if you are in that business, because rule of 40 businesses in the same research is showing higher, enterprise value and multiples, nearly 3 times those that are businesses that are not meeting that metric. So it's a great metric to explore in the concept of the misunderstood middle, because it's a balance of growth and profits. It's a discipline metric.
You know what it's about? I think that you got to swing big. And what I mean by that is I don't think you need to do stupid things. That's not what I'm suggesting. But I think a lot of businesses fall into this category of the great little business. You've heard me talk about this before, Josh. What's the great little business? The great little business is where you're paying, may even be slightly profitable. You're not really growing. You're making a little bit of money, enough to pay founders' salaries, but it's never going to return the type of returns that any investor expects. And I think there's lots of examples of great little businesses out there. And I think part of that is, what are you going to do, Mr. or Mrs. Founder, in order for you to not become a great little business, right? And I think that's a real problem, right? So many of these businesses. So I'm a big advocate for, there's definitely those type of businesses that sit in the middle. Some of them can sit at the same revenue for many years. What needs to change in order for you to get to Rule of 40?
Yeah.
Right?
And I think it's important, I think, for us and context of this podcast is that, it is a very defined stage, it is a very defined goal. In the early stages, it is a growth at all cost mentality. As a company's mature and growth slows, it's profits at all cost mentality. And that's traditionally where we see the VC versus private equity balance of growth or profits. The Rule of 40 forces a trade-off, and it needs to be very deliberate. Are you going high growth, low margin? Are you going moderate growth, strong margin, or is it somewhere in between? And so, that Rule of 40 metric is a really good one to look at.
I think as well, like it gives you the tolerances, right, of how far you want to go with that. I know with some of our previous businesses that we've worked together, I sat on the board, you were operational in these businesses. In one of those that I recall, I think you were spending $1 million a month in marketing. Yeah. And I used to ring Josh up and say, Josh, are you sure? Right? Are you sure? Are we good? Right? Like it's an awful lot of money, right? And we got great growth, right? That business is got tens of thousands of users and incredibly successful, which is amazing. But at the same time, in this environment, would we allow you to do that again, Josh? I don't know if we would. Is that fair enough?
Fair enough. I don't know if I'd want to do it again either.
No. But I think that it worked back then. But the point I'm making is I think Rule of 40 gives you the guardrails. It wouldn't allow you to spend that magnitude because you would eat too hard into profits, but it would give you some rope to give it a go. Yeah? I think that's true. So
Jay, let's do a quick fire 3 points to start wrapping up episode number 1.
Oh, wow. Yeah.
What scaling metric outside of Rule of 40 do you pay attention to that most people may overlook? You first.
I think you got to build a real business, right? Like, and I want to see profit on the horizon. I'm happy to go under the line for a period, but I want to see profits return. And I think that profits need always be on the horizon. So I think you need to have a plan in order to do that. So I think my immediate thought is the foundation of building a real business, right?
Yeah. The metric for me is employee NPS, ENPS. I think inherently people are the core of every business. In that scale-up journey, you've got to have good people working with you. You've got to know how your people are going. And so, usually what we find is, the time that you might have a wobble with your people, it's when you can least afford a wobble, and at the same time, the biggest opportunity that you might have.
The number of portfolio businesses that we see that come to us and tell us how wonderful their solution is. And they say, we've got tens of thousands of users on the system. And what's one of the questions that you and I often ask? We say, can we have the login statistics to your portal or to your solution? And you know what's crazy? And this goes back to the arrogant question that I said to you before. The number of them that have very low users actually logging into their solution. How do you keep yourself honest and make sure that you're building something that your clients really value and really want to use?
Yeah.
Sometimes we just believe, somebody would say to me, have you spoken to your clients? And we get a response like, I just know.
Yeah.
Can we please talk to the clients for the love of God and build stuff that actually people want to use?
So true.
But I don't know. I don't know if that helps answer the question, but I think part of it is keep yourself honest. Don't be arrogant. And I definitely have been that guy. I've been the guy who said, trust me, I know. Okay. But I think the biggest thing is, how do you be the voice of the client and really make sure that you're building something that your real client or customer value?
Yeah.
Yeah.
Our next question, which I think is an interesting approach to it, is what's a piece of advice that founders get that you think is overrated? For me, it's the build it and they will come.
Oh, yeah.
It's the, a great product is essential, but it's not enough. It's understand the cost and effort in customer acquisition, go to market, team. It all needs to come together. It can't just be a build it and they will come.
Yeah, it's a very challenging principle. And look, sometimes people fall into success in some of those, but you do need to be more decisive and really understand that. I guess the voice of the client definitely is relevant to me. Like I'm a big supporter of product management and really understanding, build the right things for the right reasons. Yeah.
And so Jay, last question. What's one thing a founder can do tomorrow to improve execution?
Look, I think surround yourself with the right people. I don't think that there's an expectation that every founder can do everything by themselves. I think you've got to be open to that and bring the right people in for the right reasons. I think that's true. I've always kind of built a network around me of people that I would go to for that. People like yourself, Josh, we dig in hard and you surround our portfolio businesses with clever people that can really make a material difference, right? So I think for me, I think that's really the big difference. You can't do it by yourself, right?
It's good advice. I think I would encourage all founders to go and have a go at the Rule of 40 calculation for themselves, work out where they sit, and then understand the trade-offs they're making.
And don't be a great little business.
Don't be a great little business. So
Come on, you can do better, right? Surely.
If they can look at the task that they're going through and align, is it for growth, is it for profit, and what their trade-off is, I think they'll be a lot better no matter if they're doing a task tomorrow, this week, or this month.
I'm going to start a support group for founders, right? Because I just want to let everyone know that it's not a straight line and it's always hard and there's not avoiding hard work. But I think that's really true. And sometimes a founder's journey can be very lonely. And I think that where do they go in order to help? I like to think what we're trying to do today with this is provide some guidance and support to those founders that are feeling a little bit disenchanted with their journey. And if we can do a little bit to help them with their success, I think that's a great outcome.
Agreed. So Jay, that's a wrap on our first episode. This is the first of many. We're really excited. We've got some amazing founders, operators, investors still to come onto the podcast.
Absolutely.
It's going to be some amazing conversations about all things technology and scale up and this misunderstood middle that is this area that we're going to focus on and I think where a lot of people can reconsider whether they're in the misunderstood middle. So this has been an amazing first conversation. I'm looking forward to many ahead. And if you've liked this episode, please listen to it on all your favorite podcasts. Full episodes are available on YouTube, and we're looking forward to speaking to everyone soon.
So good, Josh. Look forward to it. Thanks so much, everyone.